Even before the current crisis, the oil industry was facing really serious existential threats. It was squeezed from both ends. On the one end, supply was increasing. What happened most recently that triggered this massive supply surge was brinkmanship between Saudi Arabia and Russia, two of the biggest oil producers in the world. At the same time that supply was surging, demand started to crater. Now, demand already was a problem for the oil industry. For the past several years, smart people at oil companies around the world have been looking at macroeconomic factors and concluding that their prior assumptions about essentially an inexorable rise year after year in demand for oil were no longer valid. That was the situation before COVID-19 hit, and then COVID-19 hit. And I'm doing this video from my home because, like most Americans, and frankly, like most people around the world, I'm in a shelter-in-place order and I can't get in my car and drive anywhere and go anywhere. And multiply that around the world and you have a radical reduction in demand for oil. So the oil industry is facing an absolute 1-2 punch. It is hard to overestimate the extent of the crash in the oil sector right now. Let me just give you two numbers. Between March 3rd and April 1st, the price of Brent crude, Brent is a type of crude oil that sets the benchmark price of oil. The price of Brent dropped 52%, more than half, effectively from about $60 to about $30, which is roughly where Brent still is now. That is a life-changing drop for the oil industry. Now, consumers see it in lower gasoline prices, but if you're an oil company, that is a radically different and radically scarier world. So statistic number 2, between March 2nd and 18th, there was a drop of $447 billion with a B dollars in the market value of the stocks in the energy sector of the Standard & Poor's 500, an erasure of nearly $500 billion. Again, extraordinary numbers that cascade down from oil companies' bottom lines to retirement accounts of average people. And we are not conceivably done with this yet. A case in point of the wallop that the oil industry feels is Chevron. I spoke with Pierre Breber, who is the chief financial officer for Chevron.
Significant oil price reductions, have happened a number of times. What's different, and I think you can say is unprecedented, is the sudden reduction in demand and what looks to be likely sustained and significant, right? So even in 08-09, demand reduction, or if you go to 9/11, which is another demand reduction. 9/11 was that very sudden, but didn't last as long and didn't impact all parts of the barrel. If you go to 08-09, it happened more slowly. To see such a sudden reduction all around the world, with jet fuel, with motor gasoline. Really, diesel is holding up more because of trucking and industry and agriculture. There's similarities, but there's some big differences, and they all point to this being the most difficult one the industry has faced. No one knows what prices are going to be, but we have to plan and assume prices are going to be long for a number of months or a year, or it could be even longer than that.
It's hard to overemphasize the effect that this drop in oil prices is having in the oil patch. And one really striking illustration of it is a place called the Permian Basin. The Permian Basin is a vast swath of incredibly prolific oil producing territory that stretches from western Texas to eastern New Mexico. And just a couple of months ago, the Permian Basin was the epitome of the oil boom. Prices at hotels were through the roof. Unemployment was through the floor. And right now we are in the process of seeing that all change. So I spoke with a gentleman named Ken Winkles. Now, Ken is the head of the Economic Development Corporation in a town called Pecos, Texas.
2 months ago, we were in the mid 40s to almost 50 rigs in Reeves County alone. Last week we dropped to 31, and as of today, we're at 26. So that's had a significant impact on the drilling, which in fact goes on down the line that, the traffic is down in Pecos, I would say 50%, somewhere in the range of 50%. I don't believe that the production is going to come to a halt. But as you well know, the demand for oil is significantly down. That means we have a lot less demand, which creates a lot more supply.
There's a very strange and interesting wrinkle in what's going on, which is that at the same time that this is horrific for the global economy and horrific for the oil industry, there are actually indications that this is propelling forward the global economy's transformation toward lower carbon energy. It was generally the case that from an investor's standpoint, one earned much higher returns on an investment in an oil and gas project than on an investment in a renewable energy project. However, with the plummeting of oil prices, it turns out that the returns on oil and gas projects are now on par with the returns on renewable energy projects. The risk is lower and suddenly the return isn't much lower. So renewable energy starts to look much better from an investor standpoint. We are in the middle of a seismic shakeup in the global energy industry. There is a short-term revolution, there is a long-term revolution, and I think there's probably some clarity of the direction that this ultimately moves in. The short-term revolution is that the oil industry is hurting in a way that it has not hurt for a long, long time. There is almost certainly going to be consolidation in the industry. Bankruptcies already have started. The long-term trend is very much like what the long-term trend was before the entrance of COVID and before the cratering of oil prices, which is that there is a shift going on in the global energy industry, a pressure for decarbonizing the global energy industry. The dilemma that they face is that they have to survive long enough in an extraordinarily low oil price environment to be able to affect that long-term change. And no one, of course, knows how long prices are going to stay as low as they are.